Good morning, everyone. We're excited to have you with us. We could progress to the next slide, please. Our first topic here is an update that could have the potential to benefit many nonprofit organizations. That is Accounting Standards Update 2025-05. This ASU updates the existing credit loss model for accounts receivable and contract assets. So this relates to the process of determining the allowance on those assets. Next slide, please. So first, why did we need an update? The current expected credit losses guidance, known as CECL, became effective a few years ago. And since that time, many organizations, including nonprofits, found that the requirements of CECL were burdensome and complex, especially around the forecasting of future macroeconomic conditions. The cost and effort to gather, analyze, and document those forecasts were thought to outweigh the perceived benefits, particularly for receivables that are pretty short term, which is most commonly the balances that impact nonprofit organizations. Another pay point was the subsequent collections, which could not be considered under CECL, meaning even if you collected a receivable after year end, it still needed to be part of your CECL analysis. The FASB considered all of that feedback and gave us ASU 2025-05. This update intends to reduce complexity, lower cost of compliance with CECL, and create a model that made more sense on a practical level. The ASU becomes effective for periods beginning after December 15th, 2025. So that's now for calendar year ends, and early adoption is permitted. Next slide, please. Before we dive into what's new, let's just do a quick refresher on the existing current expected credit loss rules. So CECL requires organizations to recognize immediately or upfront any losses the asset is anticipated to have over its life. And we'll see a little later on which assets are impacted by this. But overall, the idea behind CECL was to provide more timely recognition of potential losses and align everyone under a single impairment model. Under CECL, the allowance is based on a blend of historical experience, evaluation of current conditions, and reasonable and supportable forecast of future conditions. A lot of this stemmed from the financial crisis, where many losses were not captured in financial statements until things had already collapsed. So CECL sought to fix this. Next slide, please. I'm just briefly touching on the items that are in scope of CECL. The first two items listed here are the most common ones on the left, which are trade receivables and loan receivables. You'll note that contribution receivables, however, on the right, are not in scope. So only receivables that arose through exchange transactions under ASC 606 are in scope of CECL. You see more items listed here under in scope. However, since this ASU is applicable only to trade receivables and contract assets, I won't go into detail on those. Next slide, please. Before we had CECL, we used an incurred loss model, which only recognized losses once they became probable. Evaluations were mostly driven by considering historical experience, and then CECL moved us to an expected loss model, recognizing losses expected over the lifetime of the assets on day one. Historical experience is still a factor. However, it's now paired with an evaluation of current conditions, meaning as of your year end, and estimations of future conditions using those reasonable and supportable forecasts. Next slide, please. The steps of CECL are as follows. First, we identify the assets that are in scope. Then we group items within those assets into pools based on shared risk characteristics. For example, geographic risk or past due status. Next, we determine a method for measuring losses over each of those pools. And common ones are using historical loss rates or a discounted cash flow model. And lastly, we perform our analysis incorporating that historical data, current conditions, and the forecasts. So if we use a historical loss rate, for example, we would adjust those rates for the current and forecasted conditions. If we're using a discounted cash flow model, you'd incorporate scenario forecasting. So with that overview of CECL, let's see what's changing. Next slide, please. ASU 2025-05 introduces two key elections designed to simplify CECL. Again, this only applies to current accounts receivables and contract assets. The first is a new practical expedient available to all entities to make the assumption that current conditions do not change for the life of the asset. This means you don't need to model future macroeconomic scenarios or create elaborate forecasts. You simply look at where things stand today and assume those conditions continue in the future. So that itself can be a huge boost to make CECL less complex. Next, if the practical expedient is elected, all non-public entities can also make a new accounting policy election. And if elected, you are now allowed to consider cash collected after the balance sheet date. So this approach overall is more intuitive and aligns better with how nonprofits already monitor receivables and contract assets. When implementing the ASU, you can choose to adopt the practical expedient alone, both the practical expedient and the accounting policy election, or even neither if it doesn't make sense for your organization. You just can't adopt the accounting policy election by itself. So let's review how this works in practice if both the practical expedient and this accounting policy are elected. Next slide, please. So with the practical expedient, you would determine a date through which you want to evaluate subsequent collections. For example, if your year end is December 31st, and by February 15th, you've collected everything, you can pick that as your date when performing your CECL analysis, and you can eliminate all those items collected from further consideration. The selected date can be up to the date the financial statements are available to be issued, but in practice, you generally be looking at a date earlier than that where it's practical, since you'd still need time to do your evaluation as of that date. So be cognizant of any deadlines for financial statement issuance here. Anything collected before your selected date has no expected credit loss. With the new accounting policy election for items that haven't been collected, you would apply a credit loss model and evaluate historical and current conditions. So the difference here is no future forecasting is needed. One nuance with all this, which could make the policy election not quite as beneficial as it may originally sound, is that the analysis will have to be based on the delinquency status as of the selected date, not your year end. And we'll demonstrate what that means with an example. Lastly, the use of the practical expedient and the policy election is required to be disclosed, as well as the date used for evaluating collections. Next slide, please. So let's look at a practical example. This is taken directly from the standards in ASC 326, example 5A to be specific. Here we see a population of receivables at December 31st. The example uses risk pools based on past due status and applies a credit loss rate. Notice how the credit loss rate increases from 0.3% for current up to 99% for 120 days past due. So this is our baseline for the demonstration. And now we'll look at how applying the practical expedient impacts this. Next slide, please. Here we show the evaluation with a selected date of March 1st for subsequent collections. The first two columns are the same we saw before. The next column is what the collections were through March 1st. So of the total 5.997 million, they've collected 5.92 million, leaving just short of 68,000 uncollected. Next, we're applying the credit loss rate. However, it has to be based on the delinquency status of the receivable as of the evaluation date, which is March 1st. So the uncollected items that were current at December 31st, the first row, are now in the 31 to 60 days bucket. Anything 61 days or greater at December 31st is now more than 120 days past due. This means credit loss rates will be greater on the remaining uncollected items than they would have been at year end. So this is something to keep in mind, whereas we can reduce complexity by not having to incorporate items collected after year end, we may or may not end up with a lower ultimate expected credit loss amount. In this example, the credit loss estimate is actually a little higher than what we had on the previous slide. Next slide, please. Our second example uses a subsequent collection date of May 31st. In this example, we have a remaining uncollected balance of $17,000 versus the $68,000 for March. However, now all of the uncollected items are 120 days past due, and the 99% credit loss rate is applied across the board. So still in this case, we do come in with a lower credit loss estimate compared to March, but that difference is a lot less than one might have assumed because of that past due status on the remaining uncollected items. So in summary, ASU 2025-05 is intended to reduce complexity and the compliance burden related to CECL. The practical expedient removes the need for forecasting, and the accounting policy election allows for consideration of subsequent collections, reducing unnecessary allowances. Under the ASU, you may choose to apply the practical expedient and the accounting policy election, just the practical expedient, or neither if that is beneficial. Overall, the ASU gives organizations the tools for a more practical framework aligned with how nonprofits realistically operate. Now we have one polling question before we move along to our next section. After ASU 2025-05 becomes effective, do you anticipate adopting the optional elections? Yes, both, maybe just the practical expedient, likely neither, or not sure yet.
We're going to move on to the next section. And while the FASB has been kind of quiet in regards to new nonprofit standards, we all know the industry is making a little bit of noise. So today, I just wanted to touch base on the state of the nonprofit industry and discuss challenges that organizations are running into, and some ways to navigate around these challenges. Nonprofits are seen to the public as some of the most trusted organizations in our nation. And many believe that nonprofits are the key to bridging divisions that impact our society today. It is important for individuals and organizations alike to understand the challenges that lie ahead and how it can impact the services to our local communities. Next slide. Trends and challenges. First and foremost, there has been and continues to be an increasing demand for services provided by nonprofits, particularly due to inflation and rising costs. This has been coupled with the decline in individual donations that majority of nonprofits have been facing for years. As many nonprofits' major revenue source comes from private funding, such as individuals or foundation donations, this decline has created funding gaps for the nonprofits. The public sector contributes over $1.4 trillion to the U.S. gross domestic product, which is substantial to our economy. Nonprofits also make up roughly 10% of the U.S. workforce. Not to mention, there are many more volunteers that take the place of a paid workforce that's not considered within these numbers. There are several nonprofits that would not be able to provide the level of service that they do today without these volunteers. So that previous comment goes right along with this next challenge, operational and workforce strains. There continues to be workforce shortages, employee burnout, a decline in volunteers, and limitations within innovation and growth. This affects really all businesses, governments and for-profits alike. But additionally, with the nonprofit side, the workforce strain goes along with the financial pressures that are coming from the rising costs. It is becoming harder for nonprofit organizations to maintain staffing levels and the expertise on staff while providing the same level of service if the funding is not coming in the door. So you see many nonprofits having to go, say, the contract route in order to get employees in the correct levels at their organization. Lastly, there is a growing push for strategic adaptation. More than ever, it is extremely important for nonprofit leaders to work alongside their boards to analyze current business models and look for more sustainable funding models. Next slide, please. For a majority of nonprofits, it is the organization's financial health that is of greatest concern in the coming year. There are several nonprofits out there that are closing their years on a deficit or potentially budgeting a deficit for their coming year. As we talked about on the previous slide, the decline in the individual giving is a big driver of this concern. There has been changes in the tax legislation causing some of this decrease over the past couple of years. Later in this presentation, Perry will actually touch on these changes under the One Big Beautiful Bill that does impact individual donors, and is why it is important for nonprofits to understand these changes and how it can impact them. Dependence on government funding. There are risks present when nonprofits have a heavy reliance on government contracts and funding. With certain budget cuts and government shutdowns resulting in delays and restrictions, funding is at a risk of being reduced or eliminated. With the government shutdowns that have occurred over the past year, many organizations have had to pivot or deploy alternative strategies. Nonprofits were not alone in this impact. If these recent events teach us anything, it is that we have to have processes in place to reduce these risks. If your nonprofit isn't already doing strategic planning on alternative revenue streams, do it now. There are many different revenue avenues that can be taken to diversify revenue streams, but not are all the right fit for your organization. As advisors, we encourage and appreciate having these strategies brought to the table early in the planning process. And I cannot stress enough the importance of pulling in your business advisors, whether that's your auditors, the tax professionals, or even your legal team when necessary. There can be significant compliance and tax concerns involved when you bring on new revenue streams. Your advisors are all there to help ensure the organization is doing the right thing and making you aware of both the benefits and the risk involved. And additionally, policy reform and diversified funding will help build a resilient nonprofit. Next slide, please. Planning ahead is the best path forward when uncertainty arises. So we have gathered a few examples here to consider. Various scenarios. While budgeting for donation revenue is not the easiest or most straightforward part of the budgeting process, organizations can work around that by planning for multiple staffing and service levels from an expense side to help understand how long funding can sustain operations and make pivoting mid-year easier on the organization. Internal processes. All organizations have processes in place for decision-making, but are they efficient and effective? Having a clear direction and streamlined process helps eliminate additional stress within the organization in emergency situations. Employee trust. Communicate with employees. Let them be in the know to the extent possible. Be honest and upfront about challenges within the organization. Partnerships. Continue building relationships with your local communities. Engage with individuals and other local businesses and partnerships. Those individuals and businesses are the ones that the organization will need to aid through them in hard times. Effective technology. Check that your data systems are clean, fast, and efficient so you can quickly provide results and outcomes if programs come under scrutiny. Investing in technology, while it can be a significant upfront cost to the organization, it is investing in the future of your organization. Trust and participation. Transparency, accountability, and the ability to provide clear outcomes help maintain trust among your partnerships and donors, which inspires involvement, which inspires change. And then as I wrap up this portion of the state of the industry, I did want to plug in a reminder about one of the bigger changes affecting organizations with federal funding. There were significant changes to the uniform guidance that was effective beginning October 1st, 2024. So those with September year ends, you are the first ones to experience this as part of your financial statement audits. Some of the major, which I would say good news changes for the organizations are increased single audit threshold from $750,000 to $1 million, increased indirect de minimis cost rate from 10% to 15%, and increased equipment threshold from $5,000 to $10,000. While these are not all of the changes, these are the more significant ones. Raymond does have a webinar that goes into detail on all of the changes within the uniform guidance. So if this does apply to your organization, consider going to our website to watch that free webinar, just so you're up to date. All right, next slide. So this is our polling question number 2. What is the biggest challenge your nonprofit is currently facing? Decline in individual giving, workforce shortages and burnout, dependence on government funding, diversifying revenue streams. Now I'll hand it over to Perry.
Good morning, everybody. I'm going to go over a tax update for you now. Just a quick outline. We're going to go over the priority guidance plan, work into the One Big Beautiful Bill, and then I always do like to touch on a little bit of the Form 990, the tax filing for most nonprofit organizations. All right. So the priority guidance plan for July 1st, 2025 through June 30th, 2026 was released toward the end of 2025. It's one of those IRS publications that most people never actually see, but it is very important in terms of understanding where the IRS plans to focus its time and resources. This year's plan outlines 105 specific guidance projects that the Treasury Department and the IRS intend to work on during the year. Recommendations from this plan come from taxpayers, practitioners, industry groups, so all over. I do find it encouraging that the total number of projects was roughly cut in half from the prior year. This suggests that the IRS is being more realistic with what it can actually accomplish, and hopefully we'll see more meaningful progress on the issues that made the list. The start of the slide highlights the projects in the plan that directly affect exempt organizations. So under the 501c3 issues section, the IRS is planning to issue guidance on the application of public policy against racial discrimination, and how it applies when determining tax-exempt status for private schools. And this is going to include some recent court cases that may impact that analysis. They also plan to give guidance related to the long-standing ban on political campaign intervention, which is commonly referred to as the Johnson Amendment. Neither of these are new concepts, but we always enjoy getting updated guidance and seeing the implications of those depending on how they're framed. So on this slide, I include a few things related to the One Big Beautiful Bill, which I'm going to refer to as OB3. And there's a few things in the plan that do affect nonprofits. So in particular, these are projects that are focused on regulations for the excise tax on investment income of certain private colleges and universities, as well as guidance on the excess compensation excise tax. That's a mouthful. We'll be spending more time on those two later, so I just wanted to mention one other thing, and that is they're looking to provide guidance on the Section 25F non-refundable federal income tax credit for individuals who make qualified cash, and that's cash contributions, check or cash or fund transfers, to what is known as a scholarship granting organization. These are effective for tax years after 2026, so it'll be starting in 2027. The maximum credit is $1,700 per individual per year, $3,400 for joint filers, and it's only available for cash contributions made to an SGO that appears on a list submitted by a state that is elected to participate in the program. So again, the states need to decide if they're participating in this program. More guidance will likely be issued as states opt in, but that is something we're looking to push out later. And just something to keep in mind if you're involved with an SGO or you know an organization that is an SGO, credits are always better than deductions for taxpayers. So it can be a great point to bring in additional funds. Okay, so let's go on to a few more projects on the plan. There were 46 projects listed under the deregulation and burden reduction section of the plan, with just 3 focusing on tax-exempt organizations. If these projects are completed, be on the lookout for revisions to compliance items for private foundation expenditure responsibility rules, donor advised funds, which is something we're always looking for more information on, and the public inspection rules for tax-exempt organizations. There were a total of 10 projects on the prior year 2024-25 plan. Most of these have been removed. The IRS specifically states that some projects that were on the prior year plan are not included in the current year plan because they do not belong to one of the priority categories for the purposes of allocating resources during this plan year. So we may see those in the future. It's pretty common for the plan to drop projects and they either come back or you don't hear about them for a while. I did want to note a few omissions from discussion. We still do not have additional or updated guidance on how distributions from donor advised funds affect the public support test. And I'm just going to repeat that. I think my internet dropped there for a second. So we have been looking for more guidance on how distributions from donor advised funds affect the public support test for 501c3 organizations. I also did want to mention that within the last few weeks, the IRS did release the new RevProc 2026-8, which updates procedures for obtaining and maintaining a group exemption with the IRS. And it also includes relief for subordinate organizations included in a group organization. So if you've had issues with your group or exemption, or you're considering filing for one, I highly recommend you look over that new RevProc. All right, so now we're going to move on to some of the OB3 provisions and how they either directly or somewhat indirectly affect nonprofits. So beginning with tax years after December 31st, 2025, certain nonprofit organizations may be subject to a 21% excise tax on compensation paid to employees in excess of $1 million. Now, this has been around, but it represents a significant expansion from prior rules. which applied only to an organization's 5 highest paid employees. Under the updated rules, the tax can apply to any employee once they exceed the threshold. And it's important to note that the tax is paid by the organization, not the individual. When determining the amount subject to the excise tax, a logical starting point is the compensation reported in box 1 of the employee's W-2, since this generally aligns with the IRS's definition of wages for this purpose. It's also important to note that compensation must be aggregated across related organizations, which makes coordination especially important for groups with multiple entities. And the tax does get reported on Form 4720, Schedule N. I'd say likely larger institutions such as universities, hospital systems, national nonprofits, they're the most likely organizations to be affected. But this is just an area all organizations should be aware of as compensation structures evolve. There is an exception to note, which is compensation paid to medical doctors and veterinarians. This is only included if it relates to administrative services. Right. So now we're going to move on to the university endowment excise tax. So starting in 2026, certain private colleges and universities will be subject to a tiered excise tax on their endowment investment income. This tax rate is determined by the value of the institution's endowment per full-time student, with higher rates for larger per-student endowments. To be subject to the tax, an institution must have at least 3,000 tuition-paying students, which is up from the previous threshold of 500, and more than half of its students must be located in the U.S. The endowment assets must exceed $500,000 per student, excluding assets used directly for exempt purposes. Additionally, the definition of investment income has also been expanded. It now includes not only traditional sources like interest, dividends, capital gains, but it also now includes student loan interest and federally subsidized royalty income. There are also aggregation rules, which means that assets and income of related orgs must be included in the calculation. So it's important to review the structure of endowment funds and related entities. Previously, the excise tax rate was a flat 1.4% for all institutions subject to the tax, regardless of their size of their endowment per student. Under the new law, the rate is now tiered based on the value of the institution's endowment per full-time student. You can refer to the chart on this slide for applicable tax rates. This tiered structure means that institutions with larger endowments per student will face significantly higher excise tax rates on their investment income, while those with smaller endowments will see no change from the previous rate. I think the intent here is to more closely align the tax burden with the size of the institution's endowment relative to its student body. All right, we're going to talk a little bit about charitable contributions and giving and how this may affect the donors and then also the nonprofits receiving these funds. So beginning in 2026, corporate donors, we're going to start with corporate donors, they face a new 1% floor for charitable contributions. So this means only a portion of a corporation's charitable giving that exceeds 1% of its taxable income will be deductible. So as a result, corporations, they may start to consider bunching or consolidating their charitable gifts into fewer years to maximize their benefit so they can eclipse that 1% floor. So for your side of things, for nonprofits, for your considerations, you want to make sure you communicate these changes to your corporate donors. Your campaigns should focus on educating donors about the benefits of bunching and helping them plan their giving to maximize the deductibility under this new regime. Next, we're going to take a look at individual donors. So additionally, in 2026, charitable giving rules also changed significantly for individuals. For individuals that itemize their deductions, only contributions above 0.5% of adjusted gross income are deductible. So smaller spread out gifts may no longer provide a tax benefit for those who itemize their deductions. Now, this is new and this is fantastic. For non-itemizers, they can now claim an above the line deduction up to $1,000 for single filers or $2,000 for joint filers for cash gifts to public charities, even if they take the standard deduction. So this was briefly around a few years ago, but it is now higher. The threshold's a lot higher now. And this opens the door to a large, historically untapped group of donors who may now be more receptive to target giving campaigns. So given these changes, itemizing donors should consider bunching, just like the corporate donors, several years into 1 year to exceed the new floor and maximize their deduction. Donor advised funds are a useful tool for this, allowing a large deduction now and grants to charities over time. And then I did want to mention that for donors in the top tax bracket, starting in 2026, itemized deductions, including charitable contributions, are reduced by 2/37 for income above the 37% threshold. So this effectively means the tax bracket of these deductions is capped at 35% instead of 37%. For your nonprofit consideration, again, you want to communicate these changes to donors and for those who itemize and update your planning materials to reflect the new rules. I really think there is a great opportunity to discuss the $1,000 and $2,000 deduction for non-itemizers. So you want to make sure you properly plan here so you can which will allow you to secure contributions while helping donors understand how to give in the most tax efficient way. All right, we're going to talk about just a few other provisions. So overtime compensation, this is a provision that applies to a limited group of nonprofit organizations, but I do briefly want to touch on it. OB3 introduced a new deduction related to FLSA mandated overtime pay, but it's important to understand that the deduction applies only to the additional 0.5 times premium portion of overtime. So in other words, that's the half in time and a half, not the full 1.5 times the rate after 40 hours. For example, if an employee's regular hourly rate is $20, only the additional $10 paid for each overtime hour is eligible for the deduction, not the full $30 paid for that hour. While there are additional rules and nuances that can come into play here, the key takeaway is that this deduction is limited to hours worked over 40 and applies only to the 0.5 times premium portion of overtime pay. It's also very important to note that overtime rules under the FLSA differ for law enforcement officers and firefighters, so governmental agencies in particular should review these provisions carefully. We're likely going to put more information out related to governmental agencies and law enforcement officers and firefighters. For 2025, there were no changes affecting the W-2, but the IRS did release draft versions of the 2026 W-2 showing that the qualified overtime amounts will be reported in box 12 under code TT. So this is just something to pay attention to if you do have employees that may get this deduction. I'm briefly going to cover energy incentives now. So OB3 dramatically shortened the window of opportunity for nonprofits to benefit from federal energy credits and incentives, particularly for wind and solar projects. Nonprofits that previously relied on these incentives to make renewable energy projects financially feasible or are considering projects in the near future need to act pretty quickly here. Under OB3, projects must begin construction before July 5th, 2026, and they have to be placed in service by December 31st, 2027. And this is to qualify for the Clean Electricity Investment Credit and the Clean Electricity Production Credit. Delaying could mean missing out on substantial funding opportunities that have historically made clean energy projects possible for the nonprofit sector. In addition to the shortened window, OB3 also introduced several new requirements. Foreign entity of concern rule incentives, and they would love to have a conversation with you about any projects you have in mind. And then I did want to mention just a few of the administrative wins that came out of the bill. This caused confusion for nonprofits and everyone involved with filing the tax returns because they were suddenly required to treat parking and other benefits as unrelated business taxable income. Fortunately, this was not in the final version of the bill. It's fantastic news. We do not have to all deal with that again. One other small win in the fight against administrative burdens, beginning with payments made in 2026, the threshold for 1099 reporting to independent contractors and miscellaneous income like rent or prizes increases from 600 to 2,000. So for many nonprofits, this means decreasing the number of W-9s you need to collect, 1099s you need to prepare, and payment totals you need to verify. And again, that's starting with payments in 2026. All right, so my last slide here. We are going to cover just a few things related to the Form 990. If you've been following the news, you've probably seen increased reporting about the IRS stepping up enforcement and oversight of nonprofit organizations. So one of the IRS's primary tools in that effort will likely be the Form 990, which is what they use to assess things like governance, compliance, and whether an organization is truly operating in furtherance of its exempt purpose. Additionally, donors, grantors, and watchdog groups also rely heavily on this form. So it's worth understanding which sections receive the most scrutiny and making sure they're up to date. So I think this is a great opportunity to pause, take a look at your Form 990, and look at some of these key sections and make some updates. So first, Part 3, this really focuses in on your program service accomplishments. It's where you clearly tell your organization's story. So this section it's less about checking a box with the IRS, more about communicating the impact to your donors and funders. So you'll want to tie your activities directly to your exempt purpose and be very, very specific by highlighting who you served, what you delivered, measurable outcomes, and really any significant achievements during the year. We want concrete data on Part 3 of the Form 990 that shows clear results. This is far more compelling and credible, really, than broad statements about serving the community. Part 5 here, this addresses tax compliance items. So even though most nonprofits don't pay income tax, they still have significant filing obligations, including W-2s, 1099s, and sometimes a Form 990T for unrelated business income. So later missed filings here can trigger substantial penalties. This section also covers fundraising disclosure. So just an important note here, for ticketed events where donors receive goods or services in return, think like a gala or a golf outing where they purchase a ticket, but they're getting something in return. You as an organization must provide them a written disclosure separating the deductible and non-deductible portions of their payment. So this is a requirement that's very often overlooked, and there's a check yes or no box on Part 5 that indicates whether or not you're doing this correctly. So Part 6 here, this is often viewed as the barometer of how well an organization is governed. It asks about your board size, independence, meeting documentation, and governance policies, including things like conflict of interest, whistleblower protection, document retention. Having these policies, even in a very simple form, if you just get a template off the internet, it really does signal good governance and risk awareness. This section also covers compensation for officers and key employees. You want to use things like board approval, a very objective data such as comparable Form 990s or compensation and its leadership. Part 6 also addresses public disclosure, reinforcing the expectation of transparency with key documents like the Form 990 and governing instruments. All right, I'm going to touch on just a couple more sections. Part 7. So this really does further emphasize disclosure of the 990 by requiring organizations to list board members, officers, and certain key employees, along with any compensation they receive. Officers such as the top management and financial officials must always be reported. So think your president, executive director, CFO, even if their titles vary. Compensation reported on this section is broken into wages, deferred comp, and non-taxable benefits that are paid by the organization. So really, this provides a full picture of how leadership is paid and helps demonstrate the reasonableness of that pay. All right, Schedule A. So this applies specifically to 501c3 organizations, and it's also used to demonstrate qualifications as a public charity through what is known as the public support test. So just in simple terms, the organization must show broad public support rather than reliance on a small number of major donors. If that is the case, if all you have is a small number of non-public major donors, you will end up turning into a private foundation as opposed to a 501c3 publicly supported charity. So it is very common to see errors on this schedule, and mistakes here can threaten your organization's public charity status because once they're corrected, you may learn that you are failing the public support test. And one more thing I wanted to mention is unrelated business income, or also known as UBI. This includes income from activities that are 3 things: regularly carried on, not related to your exempt purpose, and conducted like a trade or business. So we have some common examples, things like advertising, certain rentals, or merchandise sales. Nonprofits are allowed to earn this income, but it is subject to a 21% tax and requires the filing of a separate form called a Form 990T. So in summary here, taken together, these sections of the 990 tell a comprehensive story about how the organization is governed, how it operates, and how seriously it takes its compliance responsibilities. So I think this is a great time to review these areas. It doesn't just reduce risk, it strengthens your transparency, your credibility, and trust with the IRS, your donors, and the general public. So if it's been a few years since you last looked at these, now is a good time to do so. All right. With that, I'm going to pass it over to Kareem.
Good afternoon, everyone. I'm going to keep in mind the time that we have left, and really I'm going to focus on a few pieces of legislation that have gone into effect in 2025. We're still feeling our way through some of those items, and I'm going to talk about some trends that are on the horizon, things to look out for, and really what nonprofits can be doing to prepare for the future or to help ease, some of the things that may come in the future. So we've heard a lot today, and the common thread is that rules, expectations, and enforcement environment are shifting quickly. And what we're finding is that what used to be good is not good enough anymore. And you're going to see that through each of these pieces of legislation. So the first one here is the earned sick time. I think most people have heard it over and over and over again. Large employers have been operating within that law since February, whereas small employers, it went into effect in October. So while we're all under the same type of requirements, we're at different phases in that implementation. What we're seeing now really are we shift from, making sure that we have a policy in place. If you don't have one, you should have one. But it really shifts more to how it's being implemented. And what's happening with regards to that. At this point, we look at the rollover and carryovers. Are they consistent? How do you do the day-to-day administration and making sure that they're happening in a way that is in alignment with the law? We see that there are a number of ways to implement it. The law gave us that variety. You can front load the time, or you can accrue it. And depending on which avenue you chose will come into whether or not you have additional reporting requirements. So those who did accrue time coming into the end of your year, whichever your benefit year is. And for some people that can be a point in time. It could be an employee's anniversary date when they're loaded with PTO time, but making sure you actually, for accrued time, have a mechanism to record that time and make sure that you're accurately rolling it over and carrying it into the next year. The other thing that becomes a challenge for people really is how it applies in the day-to-day world and whether or not it is aligning with how you operate from a business standpoint. So ensuring that your policies are straightforward, the onboarding notices when you bring people on so they're aware of how to use that can certainly be helpful. And then helping your supervisors understand how to navigate those very quick response requests to be off without documentation. There are some ramifications that you be aware of for retaliation or for denying individuals time off that legitimately would be entitled to them. So there's a few things just there to keep in mind as you implement them, and make sure that your policies and your handbooks all align with what your practices are within the organization. The next item we're going to talk about is the minimum wage increase. If we can advance to the next slide. The minimum wage increase went into effect in January. We went from $12.48 to $13.73 and will increase again next year. I've got a table on here that provides what the details are related to that. I won't go into each of those. But what we do see is, I say, what are those impacts? We know that as you increase rates at the lower end of your scales, it can have an impact on compression throughout the organization. So while we do increase the minimum wage, it's important to keep in mind that that has an impact or could have an impact on compression throughout the organization. So make sure that you update payroll rates in your system. We recommend reviewing your compression. Take a look at those positions that are within $1 or $2 of the next individual, and really see how many people are being impacted with regards to that increase and how it will continue to impact as we continue to increase that minimum wage. So updating the rates is the easy part. Managing the compression, the internal equity, and then the messaging within internal organizations really can be the next issue that becomes challenging for individuals. So the next item we're going to talk about is, can we move to the next item, is going to be unemployment. So unemployment went up, which for those who are unemployed provides them with $530 rather than the $446. But what we see from an employer standpoint is that the unemployment is looking more closely at the reasons why we have why people may have been exited from organizations. They are really cracking down or looking with more scrutiny to voluntary quits, medical related resignations, or no call, no show separations. And really, it's about documentation, making sure that you have the documents in place if you do happen to terminate somebody, making sure that you standardize your resignations so that you have a consistent practice that's being used throughout the organization. In HR, common theme is document, document, document. You can never have enough documentation. And really for no call, no shows, that one we would think to be very easy. They're not here and they're not doing their job. Making sure that you have great documentation with regards to those types of instances are going to be really important. And again, training your supervisors to adhere to that as well. The next item was touched on from a different facet, and that is the OB3. If you can move to the next slide, please. There are a couple things that I just wanted to touch on. I won't go into a lot of it with regards to this, but there are some that impact from an HR perspective. Most importantly, the increased transparency requirements. So there are other pieces of legislation, which I'll talk about in a few minutes, that are even more strongly worded and have been implemented in other states that we should be aware of as we talk about pay transparency. But In this case right now under the OB3, making sure that your pay decisions are documented, that they're explainable, that there is, that really they're defendable, right? Just relying on, it's always been done that way, or legacy pay practices without documentation or clear governance is not going to help you in the long run. We certainly need to make sure that there's the alignment between, the human resource finance and leadership and ultimately approval of uh, those that are authorized for approving such increases or pay structures. So that is all I wanted to touch base on there. There's more coming by way of other states that are much more in depth that we'll watch on the horizon and may impact us in the future. But the pay transparency really is one to be consistent with what your practices are and making sure that they make reasonable sense in how you've applied them. So the next item we're going to talk about is, and this again was one that came out under the federal government last year in January. And that was the executive order that declared DEI programs prohibited in federal agencies. So if you receive federal funding, if you receive pass through federal dollars, of course, you're going to want to pay attention to how you're structured. Now, it didn't make DEI illegal, though it came from that standpoint. It felt like that's what was being said. It's not. You still have your EO laws that are in place, anti-discrimination laws that are still in. You're not prohibited from serving populations. There's a whole lot of things that have been provided that that still protect those interests. What we would advise is making sure you're taking a look at how you have framed your initiatives, right? Looking at policies, looking at how you're training, looking at really how you frame it. So it's really, are you looking at workplace respect and professional conduct, equal opportunity and fair access, inclusiveness? And I think it's just a matter of how we deliver those services in a way that comply with this piece of requirement from the federal. So, but those who have federal funding, I thought it would be important to share that with you. The next item that we're going to talk about is, there's a polling question. All right, the polling question. Is your organization ready to comply with the Michigan Earned Sick Time Act and minimum wage increases in 2026? Yes, we are fully prepared. We are somewhat prepared, but need more adjustments. No, we are not prepared, or this does not apply to us. So I think it would be difficult to find anybody who it may not apply to, but hopefully you're well on your way of being prepared. The next slide I'm going to bring up is on independent contracting. Oh, wait, here we go. So, yeah, we're going to move into trends. So some of these are items that will impact in the future. So independent contractors, just to pay attention beyond the horizon of really cracking down on whether or not they qualify as independent contractors. So be aware of those practices. Make sure you run an audit, determine whether or not you're in compliance with that. We'll go to the next slide. I know I get the run at the end of it. Again, this is again on the independent contractor and the work classification. They are tightening up on that. It's important to make sure that you run them through a test and make sure that they really aren't providing the same services that you are, just in a different format, to avoid, maybe you don't want a full-time employee, but if they're providing the same services, you really want to make sure that they are, there's an ABC rule, which I refer here, and that really is it the autonomy? Is it the type of business that they're doing? And then making sure that they are certainly complying with that. If you are unsure, feel free to reach out. We're happy to help you. and make sure that you're in compliance with that. The next is national trends on pay transparency. I'm not going to get into those, but there are other states that are on the horizon or really on the cusp of doing things that are different than what we may be doing here in Michigan, Ohio, or other areas that may be on this call. So be aware that there are other states that are far more advanced and are taking action in pay transparency. AI, from an HR standpoint, I just put some tips in there with regards to if you're using AI, if you're going to use it for hiring practices, be very well aware of what you're actually using and what those algorithms look like, and make sure that there is no bias in it. There's a lot to be said about what, knowing what you're purchasing, right, and what you're utilizing within the organization. I know I had to fly through these. I think the next one is going to be another polling question, if I'm not mistaken. Oh, what you can do to prepare, you certainly can utilize that. Those are just tips for you in the items that we've talked about before, how to prepare for what's coming in the future or to make sure that you're set for what's happening now. And then there is another polling question, which we'll get into, but I do want to thank everybody for being here, for your time today. We appreciate the opportunity to share this information. We know for nonprofits, the question isn't whether these trends will reach us. It is really whether we're prepared when they do so. I'm going to turn it back over to Christina.
Thank you, Corrine. I'm going to launch that final polling question. What area of strategic planning is your nonprofit focusing on the most for 2026? And as you answer that question, I wanted to thank you for joining us